Please welcome the panel on Global Markets at Inflection, moderated by Editor-at-Large of the Wall Street Journal, Gerard Baker.
Good afternoon, everyone, and thank you very much indeed for joining us here at this Milken Institute conversation on the global financial markets. As you heard, I'm Gerry Baker. I'm editor-at-large of the Wall Street Journal. We have a great panel to discuss this. I'll introduce them in a moment. This is the point where people often say my panel needs no introduction and then proceeds to give a very long introduction of everybody in the panel. I won't do that, but I'll just briefly introduce them. On the far left, I'm sure you know Andre Esteves, Chairman and CEO of BTG Pactual from Brazil. We have Bruce Flatt, CEO of Brookfield Asset Management, Jenny Johnson, CEO of Franklin Templeton, and Charlie Scharf, CEO of Wells Fargo. Let me remind you, you're all familiar with this, of course, by now, you know the drill. Do please ask questions. We're going to have lots of time for questions from the audience. I'm sure you've got really good questions to ask our panel. You know, you hit the QR code and they will magically crop up on my tablet in front of me. So the context of this conversation, of course, is the pretty turbulent financial markets we've had in the course of the last few months. Some will say, when are financial markets not turbulent? One of my friends always like to say, when he talks about economic and financial history, in the post-crisis period, by which I mean the pre-crisis period, there is continual turbulence. But we have had a particularly, and this is the reason for the title of this panel, we have had a period that does seem to have represented something of an inflection. We came into 2024, of course, very, very bullish. Everybody expecting the Federal Reserve, not everybody, but certainly the consensus in markets expecting the Federal Reserve to cut rates 6 times, I think it was. Bond yields were coming down as a result. US markets were doing particularly well, equity markets as well, but this was spilling over to a large extent into global markets too. We've obviously had a pretty significant adjustment in expectations and therefore in markets over the course of the first 4 months of the year as stubbornly persistent inflation has proved to be stubborn and persistent, much more so than the markets were expecting, and of course more than the Fed was expecting. And of course now those expectations for rate cuts have come down dramatically to just one 25-point rate cut in the course of this year, and as a result bond yields have gone back up, and we are at an interesting phase, I think, of this particular market and business cycle. So I want to get into that. That's one of the first things I want to talk about where we are, how we got here in the course of the last few months, and most importantly, of course, where we might now go, whether we've sort of seen the worst of this market adjustment. But I also want to dig really as deeply as we can into the longer-term trends. We're obviously all being buffeted not just by these short-term financial movements, but of course by these longer-term trends in the global economy that we're all familiar with, to do with technology and geopolitics and the environment and so many other aspects. And I know our panel have lots of interesting things to say about that. So let's start with the immediate environment, as I described it there. We are right now, again, at the beginning of May. We've just had the Federal Reserve meeting last week. No expectations for rate cuts in the immediate future. Bond yields remain quite elevated. Let me start. I'm going to start what all the panel thinks about the immediate outlook, given what we've seen over the last few months. And if I can start, Jenny, with you, Jenny Johnson from Franklin Templeton. What's first of all, give us a sense of how you've observed the events of the last couple of months, to what extent they took you by surprise, and what you now expect looking forward in the next few months.
Wow, it's loud. When I became CEO, and people always ask me, suddenly I would know exactly what was happening with the markets. I used to be really hesitant, and then I realized nobody ever remembered what you said, so I've learned to just give really definitive answers with confidence. So I'm going to tell you exactly where the markets are going. One is I do think that, obviously in the U.S. economy, it continues to be strong. I think if I were to bet on rate cuts, I think you get one, and it's not till the second half. And I think that despite the most recent jobs report, you look at super core inflation, it's still quite high. It's like 3.5+%. I think the Fed is going to be very data-driven. And I think, I don't know, maybe I live in a bubble, but you go out, every airplane you get on is full. The restaurants are still pretty full. Wages are still increasing. So I think it's going to be tough for the Fed to get this to inflation number that they want to get to. So I'm going with first guess is 1. If I have to pick a second one, I'd say actually 0. I'd go down to possibly no cuts, just because I think it's going to be more sticky. And then I think on the markets, it's been interesting this year. If you look at earnings, and oftentimes the most optimistic earnings come out in Q1, and then by Q2 they kind of revise down, but that's not the case. There's been a slight revision up. And so I think that while it's probably expensive versus historical times, and obviously we all know about the dispersion of the Magnificent Seven and the concentration there, but I actually think we're going to continue to see a pretty strong market and end up in positive for the year.
Thank you. Andre, for an international perspective, I want to come to you. How do things look? I've talked, I confess, heavily about the US conditions, but how do you see things from an international perspective?
Well, first, I was talking to Jenny before the panel, and it's relatively easy to have a call on rates for the next months, because certainly the volatility is so high that the market will cross your answer, right, in a certain moment in time that you appear to be right about your call. But having said that, I'm less worried about the short term. I think U.S. rates are definitely in restricted zone, and we did a quite good job, right? If you go back 18 months ago, the key uncertainty in a panel of these was how deep was the recession necessary to bring inflation from 9 to 2, right? And I think we crossed this big answer, honestly. I think we are in the last mile of the inflationary adjustment. If you look at the PCEs between 2.5 to 3 or CPI at 3.5, we are not that distant from 2% with rates at 5.5. I think we did most of the job. Of course, the short-term markets move according to short-term perspectives, and in this sense, the Fed has been sometimes adding volatility together with the market, or in a certain way being long gamma, if in a more technical language. So markets were over-optimistic by the end of last year, and the Fed kind of tag along with the markets, and then the opposite. But I think we did most of the job. What is concerning me more is about the long term that you mentioned, where if you look at any serious academic study about what is the neutral rates, real rates in US, probably you have something between 50 bips or 1%, very seldomly 1.5%. And for a few months, we have US tips trading at 2% or above 2%, and long-term tips trading at these levels. And I think this is an interesting question. Why is it happening? It's not because inflation is 100 bips ahead of the targets. Something more serious than that, and I think it's the structural deficit of U.S. economy and the lack of serious discussion around that. I'm surprised about, my country in Brazil, we still have a deficit, we still have a challenge in terms of fiscal adjustment, but at least the problem is over the table. Here, what I see, and from the moment or even from the election that is coming, no serious debate about the deficit, the long-term U.S. deficit. And even if you are the owner of the printer, there is a limit to print. And in a certain way, markets are telling us that probably we are not so distant of that. So worries me seeing tips trading at above 2% rates for 30 years, for 20 years, or for 10 years. It's not a short-term monetary tightening cycle. Goes beyond that. So that's my
I want to come on to those longer-term things, but just in the immediate future, I mean, one of the questions, obviously, that's been on mind, particularly of a lot of international investors, is obviously exchange rates of the dollar. We've had a pretty remarkable run-up in the dollar, particularly against the yen, over the course of the last few months. Do you see, and some other currencies too, it's been a bit mixed. Do you see do you think that is now heading into reverse? Do you think that, or do you think the US dollars, Jenny talked about the resilience of the US economy. Is that kind of just a plain fact now that we can expect kind of dollar strength over the...
Generally, we are in a strong dollar mode, right? And sometimes we look at, well, currencies are the most difficult markets to forecast, right? People say that the floating rate regime was created to keep economists' vanity under control, right? So, which is a good call, because they always forecast and it's always wrong, which is part of the job description. But having said that, I think we like to identify macro factors for currencies. That's our training. We all think about that. And if you look at U.S. differentiation to Japan, it's clear that there is a factor on that. But regarding global currencies, I would add something that people talk less about, which is the microeconomic factors. I think the extremely strength of U.S. capital markets above of any other market. And this is a kind of a financial black hole in terms of attracting capital from everywhere. If you take a middle-class boy or girl in Colombia, like the idea of having some Apple stock, some Bitcoin, and it's the same thing in Colombia, in South Africa, in Australia, in Japan, and in France. And these extremely strong capital markets, amazing innovation, fantastic companies, I think has a relevant role in the price of the dollar, more than the classic current account deficits or interest rates. I think the microeconomic factor, or in other words, the attractiveness of the U.S. capital markets.
I'm sorry to keep going back to it, but I mean, I guess what I was thinking about is, somebody famously said, the U.S. Treasury Secretary famously said, the U.S. dollar is our currency and your problem, talking to the rest of the world, right? And you can see, again, with relatively high inflation still in the US and a high dollar, the concerns are that the US is, again, with sort of buoyant commodity prices in some areas, it could be exporting inflation to the rest of the world, but you don't see that, you don't think that's a major constraint right now. And again, we are going to get onto these longer term factors, but the strength of the US dollar is not right now a major risk for global markets, you don't think?
I don't see that, because I'm more constructive on the US monetary policy and inflation conversion, and I think the world is reacted for that, right? If you look, the net export growth in US is reducing. So the markets are doing the job. With yen close to 160, of course, the trade balance between US and Japan will change. And I think it's going on, it's happening. The recent moderation of growth in US, part of that is related to reduction in net exports growth. And my forecast that it will continue to reduce. So I don't see a problem. You see normal functioning of the markets. I just call the attention of these ultra strong capital markets in US. Where you would see, look at NVIDIA stock, right? I'm not saying it's cheap or expensive, but you created $2 trillion of value in 24 months. So it's amazing, spectacular, rightly or wrongly, but in terms of the exact valuation, but the value creation, the innovation, the opportunity of investment, it's bigger than anyone else. And it's part of the dollar strength. Okay. Structural dollar strength.
I want to get into a lot of those things you mentioned, and Jenny's mentioned too, the strength of technology companies and the Magnificent Seven, and the longer term outlook for the U.S. economy and for technology stock and for technology generally. But just Charlie, just back to this immediate question, this immediate outlook. Have you been surprised? Everybody's been surprised, I suppose, by the way markets have behaved in the first half of the year. That's the way it works out. But do you think we've now, is the market now priced in, as it were, all of kind of the bad news on interest rates, all of the bad news on inflation?
Well, first of all, I don't think people should be surprised at exactly where we sit. I mean, because if you separate out what we know versus what we don't know, and the reality is what we know is that the economy is still extremely strong. Consumers are still doing really well. Business are still doing really well. When you look at the financial position of each, all things considered, given all that we've been through, it's not as good as it can get, but it's really strong and very, very consistent. And we're always looking at our different portfolios of whether it's credit or on the consumer side, looking at spending patterns, looking for weakness, and you got to look really deeply to find anything that's weak. And that hasn't changed. That's been that way now for a very, very long time. And so, that's what you know. Then you've got, everyone hanging on every word of the Fed. And the reality is markets like certainty. And we're not in an environment where there's going to be certainty on exactly when inflation is going to get to the expectations that the Fed has laid out. And so by the very nature of it, no one's going to get that exactly right, and then the market's going to react, and so we're going to be whipsawed by that. And so that happened expecting too much in terms of rate cut, and now we're sitting here saying, have we adjusted and where are we going to be in that? So I think the reality is there's going to be this period of continued volatility, recognizing that the Fed is trying to be as clear as they can about what they're looking at, giving you a sense for what they think their expectations are. But the reality is, when you come down to it, they've got the rate that they set and they've got their balance sheet. That is a lot to control when you're targeting 2% inflation and low unemployment. Very, very difficult to predict everything with a degree of certainty with those tools when you've got state and federal spending at all-time high.
Bruce Flatt, your perspective on where we are and what the immediate outlook is?
Look, I'd agree with all the things that were just said, but I'd just add that, and maybe it's our perspective, we don't trade stocks, we don't trade fixed income. Short-term rates and rates tomorrow morning or next month or next week really matter to those two things. They shouldn't matter to equities in the market, but they do. What we do is buy businesses and assets for the next 25 years. And what matters and what's happened over the last 9 months when Powell said rates are capped, they're going down. And he said it again the other day, they may be higher for a little longer, but they're going down. And the inflation trend is down. For the things that we do, what matters is just that trend. And what that trend says, and what it said to people is, we had 2 years of hiatus and nothing happened, and now the markets are back, and every month, the markets are getting better. And despite whether inflation or whether cut happens in June, November, January, whatever it is, we're on a trend, and that just means it's brought stability back to the markets. It's brought transaction activity back to the markets, and that's going to continue to go forward. So we don't really care. We'd rather have it quicker, but it doesn't really matter, and I think people get too wrapped up in those things, and largely it's because it matters to fixed income and it matters to the equity markets. But if you're not in those, it doesn't really matter.
All right, well, I'm going to stay wrapped up in those things just for a little bit longer. You all seem reasonably confident that that we are, inflation will, despite the bumpiness and despite the persistence that we've seen a little bit in the first few months of the year, will come down, the growth will continue. But of course, there is a view, I heard it expressed by someone last night, that actually, we may not be done with the downward inflation trend. There are a lot of things to be concerned about in terms of we're looking at wage growth, looking at some of the service inflation in particular, and that the economy may be slowing. We have had a little bit of a slowdown in the labor market. Jamie Dimon, the CEO of JP Morgan, recently used the dreaded S word, stagflation. Just quickly on that, any of you, Jenny, let me start with you. Do you see any reason to fear, that we could actually we are flirting with that possibility of the worst of both worlds, where inflation remains high even as growth slows?
So I think the thing that doesn't get enough conversation, because everybody's so focused on what's the Fed going to do this month, next month, this year, is U.S. debt, which I think is where Jamie Dimon was also talking about. And if you look at it, so I think it was in 2007, our debt was $9 trillion. Now it's close to $33 trillion. Our largest foreign buyer is Japan at $1.1 trillion. Second largest is China at about $800 billion. Neither of those countries are going to buy more debt. We're adding anywhere from 1.5 to 2 trillion a year. It doesn't feel like that's changing. And then you need buyers of that debt. That doesn't mean there aren't going to be buyers. There'll be buyers. But I think the thing that becomes very difficult is who can control the longer end. The Fed's going to have a harder and harder time controlling the longer end of the curve when they have to go out and raise money. Because it's going to have to be insurance companies, corporates, the Fed, right? So the Fed's been trying to reduce their ownership of treasuries. They actually have had this little tweak to monetary policy where they were retiring $95 billion a month, and now they're doing like $60 billion a month. Well, that's inflationary. So I think to Jamie's point is this kind of, we're all focused on sort of what's happening in this shorter term, but I think longer term, the U.S. has got to deal with this issue. And you cannot continue to spend at the pace that we spend. Unfortunately, I worry about us raising taxes and things like corporates. That always goes after the corporations. Well, U.S. companies have to compete globally. And so if we tax them here, it's less dollars that we have to spend on R&D and expansion, and you got to compete with competitors. So I think that's the concern. I don't think it's an immediate issue.
On the debt issue, and again, I want to talk about some of these things longer term too, but on the debt issue, my experience seems to be that only when the markets really kind of signal, I don't want to say panic, but signal real alarm, real concern about the fiscal position. We've seen it once or twice in the course of the last 40 or 50 years. Only then are politicians likely to respond, or policymakers likely to respond. Is there anything in the elevated, bond yields that we've seen? Anybody can weigh in on this. Charlie, Jenny, Bruce, Andre. Anything we've seen in these elevated bond yields that signals to you any concern in the markets about the sustainability of the fiscal position?
I think that obviously they've been able to raise money, but they've been doing it on the short end, right? So they haven't, which would tell you that they think that the longer end is going to go down. It's not a problem until it's a problem. And again, there will be buyers of U.S. Treasury. That's not the question. There's no other reserve currency that makes sense. It just becomes at what price. And if you're trying to ultimately drive interest rates down and you still have to attract investments versus other investments, every year you got to have $1.5 to $2 trillion more dollars invested in U.S. Treasuries that you didn't the prior year. So there's got to be investors there.
I mean, Charlie, if the markets don't seem that concerned about the fiscal position, why should we expect policymakers to be?
Well, listen, just got to be very practical of the way Washington works, right? Which is that Washington has a lot of things on their agenda, and they react to the things that they've got to deal with in the shorter term. And so to stand up and say that the deficit is the issue we have to deal with today is someone putting political capital into something which is going to be very hard for them to get done. So unless it's someone in an administration or in as part of a campaign, it's going to be very hard to get traction until there's some kind of event which makes people realize that it's time to do something about it.
Bruce, I'm going to respectfully skip you because you say none of this matters in the short term, but I will promise I will come back to you. And Andre, you've talked a little bit about this. Is this, again, I put the same question to you. The markets don't seem to be that alarmed right now. So despite the fact that we all agree we've got this huge explosion in the deficit, explosion in the debt, doesn't seem to be too much of an immediate concern.
Yeah, but I will go first to your comment about stagflation, and I think it's a total exaggeration talking about stagflation in US, right? I come from Latin America, and the stagflation is very different from what we are seeing in US. Be sure that, trust me on that. Having said that, we are, just to remember, the PCE is the targeting of US inflation targeting, not CPI. So we are 2.8 after a strong first quarter. So we are not that distant from where we should. Stagflation is not what we are going through. We have healthy growth in US, even moderating, and inflation is slightly above the targets. Having said that, your second question about deficit, markets are already sending signals about that. My comment about the real rates on the long term, I think it's a signal of what Janie said, that US is issuing more debt and with less new buyers. Something is not matching here. And the markets are giving us, even in this point of the cycle, where we are in the peak of a tight monetary policy, long yields are the same price than short-term yields, real yields, right? So it's a signal, a clear signal about something's wrong about public finance. And of course, it's not a dramatic signal, it's not a huge volatility until it is. So my concern is that this is the first clear symptom of something wrong. And even though that the dollar is the global reserve currency of the world, there is always a limit to print, even if you are the owner of the printer. So that's my
All right,
take.
Bruce, I did promise to come back. So let's look at some of these longer-term issues and trends that are driving markets and going to drive markets. And we're at an inflection point in another sense, rather than just the short-term inflection point. And again, you may disagree with this, but it seems to me we're at an inflection point in terms of just a pretty significant structural shift in terms of global financial conditions, particularly, let's obviously take interest rates. You know, we have had this period from roughly the turn of the century, with obviously ups and downs, including the little down of the global financial crisis. But broadly speaking, you know, relative, again, low inflation, a very, very low interest rate environment, particularly after the global financial crisis, this long period of effectively zero rates. In some parts of the world, we saw negative rates. I want to ask each of you. Let me start with you, Bruce, since you talk about the long term. Was that a sort of, was that a brief kind of ahistorical, fleeting moment? Are we now? Do you expect any kind of prospect of a return to the sort of pre-pandemic, a period that characterized global markets then?
Yeah, look, I think everyone reflects back to recency bias. Everyone thinks of 2020 to 2022 when rates were zero on the front and the back. And we're not going back to that, but that wasn't normal. That's what wasn't normal. When you go back 5 years ago, the long end was 3.5, and now we're 5. Or 2.5, and now we're 5. That's not that much different. If you trade fixed income, maybe that matters. But when you buy businesses, when you're an industrial business owner, when you own real estate for the long term, 2 points shouldn't matter, and any investment you made that mattered, 2 percentage points on your debt mattered, you shouldn't have made the investment. So I would say we're not in a high interest rate environment. The freak out was that we were going to 5 and we were going to 10. And if we went to 10, we were back in a high interest rate environment. We're not going there. I don't think we ever thought we were going there, but that's what the worry was that was out there, and we're not going there. So I think we just need to get used to a little bit higher rates, and most businesses, most assets can absorb that. And I'd say maybe the most important thing to add on to this discussion is that there is a investment boom going on globally that is going to contribute to an enormous amount of wealth creation and industrial growth around the world. The money that's getting invested into the transition of the global economy and getting carbon out of the system is tens and tens and tens and tens, if not hundreds of trillions. The amount of money going into the digitalization of everything, and AI is only the newest portion of it, but between fiber, towers, data centers, and the whole backbone and rewiring of the economy for less carbon and more data is an incredible transformation of the economy, and all that is productive, and it will add some amounts of inflation, but there's bad inflation and good inflation, and this is actually investment-led growth to the economies. And remember, what we were all worried about 5 years ago was actually deflation. Like, everyone forgets that we were petrified over deflation, and we actually wanted to induce inflation, and this investment boom is what's going to do that, and it's a highly productive amount of inflation.
Let me ask the rest of you, Charlie in particular, do you agree with that? That obviously, exactly as Bruce said, we did have that exceptional period, 20 to 22, when no one knew quite where the economy was going to go, and we had incredibly loose monetary conditions. But I would also point to, we had quite a long period, and again, you can argue about when it started. There was the global savings glut that I remember people talking about in the even the late 90s, certainly the early 2000s. We had the search for yield that people were talking about all the way through the, sort of the post-financial crisis period. I mean, nobody's talking about search for yield now. I can go to open a CD at Wells Fargo, no doubt, and probably get, I don't know, what, 4 or 5% on a 6 month money or something like that. So, I mean, is this back to normal, as it were, Charlie, in your view, or are we still adjusting to this whole post-pandemic kind of inflationary phase?
Well, when you talk about back to normal, I mean, you remember when you look at the yield curve shouldn't be what it is over the long term. And so if you're talking about long-term rates or short-term rates, you're talking about two different things. There's no question, I mean, I agree with Bruce, when you look at where rates are today, to act like rates are very high, if you're a long-term investor, it's not the right way to think about it. It's not what history would show. But the other side of that is not everyone is a long-term investor. Not everyone has the time or has that kind of investment horizon. And the fact is we have gone through this period of ultra-low, near zero, if not zero, interest rates. And a lot of people did a lot of things in that period of time, and there were knock-on effects for what the Fed did with its balance sheet and whatnot, which need to filter through the system. And so those things are not easy to predict, will have an impact on individuals and on select businesses in the shorter term, which will impact certainly the path of what the kind of the shorter medium-term outlook looks like. It doesn't change the long-term prospects for what rates will be or what growth looks like, but there is that adjustment which has to occur. And there certainly, again, we look at everything in our business, and everything looks very, very good. With pockets of exceptions which are very idiosyncratic. So you look at that and you feel really good, but at the same time, there is a lot that's going to continue to unfold as people get used to rates at this level, have to refinance, and whether you're a business or you're a consumer, all the financial transactions that have done in the corporate space, that'll create a lot of noise around the question of what does it all mean. I don't think it changes this longer-term trend of how optimistic we should be. But again, it comes back to what the markets want. The markets want certainty, and we've not had to come through an environment like this, so there's going to be a lot of unpredictability, and we're just going to have to live with that.
You say everything looks very good, and I don't want to get too deep in the weeds here, but I mean, one area which, I don't know your exact exposure, but others might want to weigh in here on this, but I think it's a very interesting topic, is commercial real estate, right? That is clearly, and particularly in major urban centers here in the United States, here in LA, but particularly in San Francisco, we've seen it in New York too. And that does seem, that again, this seems to be a function of a structural as much as a cyclical thing. I mean, how do you see that?
Bruce and I were talking about this earlier. First of all, commercial real estate's a very big picture. And when you look at commercial real estate overall, commercial real estate is actually doing very, very well, with the exception of office properties or multifamily, which have, whether it's rent controlled, rent stabilized, that have different characteristics than what people broadly think of as multifamily. So there's actually a huge amount of liquidity away from the office space. There's in terms of how those portfolios are performing away from office, they look really, really good, and we expect that would continue. The reality of the office space is coming out of the pandemic. Office work patterns have changed. There's a huge discrepancy between companies, that are going to continue to occupy the space they have, those that are downsizing. So if you have a building which is a company which is significantly downsizing, you're going to have a problem. If you have a B property as opposed to an A trophy property, the A trophy property is still going to do extremely well. So I think when you think about the problems and the issues we have, office is a very specific problem, which is quite manageable.
Bruce, is that your...
Yeah, there's a tail of Class B offices and offices in cities that aren't doing very well, and that's got to go through the system, and that's the adjustment that Charlie's talking about. Premium office and globally office is actually doing extremely well, and rents are much higher than they were pre-COVID. So there's a big disparity of New York City. Office buildings in the top 25% of buildings in the city are 100% full at the highest rents ever. If you have the bottom 25%, they're 50% vacant, and it's not good news. So that's the adjustment Charlie talks about. But commercial real estate, I agree 100% with Charlie. It's globally, it is actually in really good shape, even office more, because people didn't need to adjust their patterns. So they all went back to the office. And the financing markets didn't change as much. A lot of the issues, or some of the issues in the US are caused not by fundamental issues, they're actually caused by financial issues. Can't attainable today, and therefore the owner needs to restructure. And that goes through. Charlie can tell you this. I suspect his book is very well structured, I'd say, across the financial system. Real estate at banks,
even in smaller regional banks, things like that. No?
Yeah, I'm not. There,
Okay.
there will be. We have seen some issues there,
Yeah.
and there may be some more. But those generally are lending to different types of real estate.
Yep.
But it's not. It's not a big issue anymore. This is last year's story.
Yeah.
And just to put it into perspective, I mean, we have a $2 trillion balance sheet. We've been managing our exposures quite well in the commercial real estate space. So the office space that we're concerned with, we'd say, is, call it $21 billion of properties. We have $2.5 billion of reserves. Okay. And so if we lose it, we've lost $2.5 billion. But in the context of like the size company and the exposure, it's not going to create the kind of problem that people have talked about that it could potentially create.
Jenny or Andre, do you want to weigh in on this, or we want to move on? Because I know, Jenny, I do want to ask you, as we talk about these longer-term structural issues, I know you think about these things. Everybody has kind of these various mnemonics or acronyms for thinking about things. But tell us about, everybody's talking about how many Ds do you have? Numbers of Ds that you may have.
Well, we already talked about 3 of them.
You've got 3. So tell us
No, I
your
got
3
5.
Ds that are going
But we
to.
already
Sorry, you got
covered
5. You got 5. Tell us your 5 Ds that are going to drive.
Everybody's got their Ds.
The sort of structural things that are driving markets.
Well, I mean, so the 3 we talked about were basically the decarbonization, which I think is a big investment opportunity. So these are kind of macro trends that I think will inform how people are thinking about broad investments globally. So one is decarbonization. You got 90%, governments who represent 90% of the world's GDP committing to carbon neutral by 2050. There'll be investment there. Whether they get there or not doesn't really matter. There's going to be investment there. The challenge, of course, is it requires, I think, genuine hybrid financing, because a lot of these projects don't make sense. And so hybrid financing where there's some sort of government policy stepping in. But I think it's a very real trend, and infrastructure is going to be important. Digitization, which you talked about, I mean, you're finally seeing in the US actually productivity improvements, right? So when we talk about whether it's inflationary or not, and the efficiencies that companies are going to get from things like AI are significant, and that hasn't even started in the productivity numbers, but you see productivity improvements. So, and I'm a big fan of blockchain, so I think a lot of innovation happening there is going to, one, be investment opportunities, and 2, the companies that are good at using it. So today, if you invest in an AI, it's kind of like the picks and shovels of the gold mine, right? You're in the NVIDIAs and the cloud services and maybe the data centers, but you're not yet investing in companies who have figured out how to make themselves better from it. And you'll see disparities, I think, in performance as companies figure that out. So the digitization, then we talked about it, because we needed Ds, disinflation and debt. And then the other 2 are just demographics. The reality is it's kind of an interesting time in the world. If you think about basically developed markets, population is going to increase about 4% by 2040. In like frontier markets, it's 44%. You go to a place like India, 56% of a population of 1.4 trillion people is under the age of 25. So you can be a growing economy if you have a growing population, but you better educate them. And that's where there's going to be a great challenge. And then, of course, for aging populations, if people live, somebody read something, we're going to have the person today who's going to live to 150 is alive now. Well, that's kind of scary if you think about a depleting younger population having to support an aging population. So demographics are going to be tricky, but also we'll have investment opportunities. And the final is just deglobalization, and we see it because of the macroeconomic environment and the geopolitical environment. And obviously with US-China, things like this China plus one, or the global supply chain being distributed, that's by itself is inflationary, right? There's a reason we were all, companies were investing in China. It was cheap, and now if it's a China plus one story, that's going to be more expensive. But they're great investment opportunities. I talked to somebody who does supply chain stuff in Hong Kong, and he said, listen, the Chinese companies that are selling to Walmart and other places, they're just setting up a factory in Vietnam or Malaysia or in Indonesia, and they're constructing whatever their item is at the last mile in that location, just enough to meet the WTO requirements to stamp it made in Indonesia, and bypassing any of kind of the tariffs. Those are also good investment opportunities. So I think those are some of the big global trends.
Andre, feel free to pick up on any of those, but I particularly want to pick up on the last one, deglobalization. Obviously, you have a very international perspective, and how much of a reality it is. We hear, obviously, Jenny's just talked about the US-China tensions and how that's impacting the nearshoring, the protecting of supply chains, the building of resilience, all of these things that do seem to, again, result in reduction in the kind of international economic engagement that we've seen over the last 25, 30 years. How much is it going to continue? And obviously the $64,000 question: how do you prepare for this from an investing perspective?
Well, first, regarding your first point on the many Ds, if they are inflationary or deflationary, I think clearly demographics and digitalization are deflationary, decarbonization and deglobalization are inflationary. On a net basis, I think we are kind of neutral on that, given the amazing gains that AI will bring to us. And even with all the required investments in digital infrastructure, data centers, fibers, and so on. But I think clearly it's a huge productivity gain. Having said that, I think the deglobalization is a reality. Again, 18 months from today, if we are here discussing, we were afraid of moving to a divisive world. Unfortunately, we are not afraid of moving. We already move it. And I don't see convergence on that. We continue to move towards this direction. And it's a reality. We do see in countries like Mexico or Brazil clearly nearshoring movements. And if you go back in 500 years of history, any big political or geopolitical dislocation, you have winners and losers, right? You can take the most remarkable of that, US during the Second War, right? It was a humanitarian disgrace, but it was positive economically speaking for US in terms of opportunities. This is happening today. On a net basis, deglobalization is bad for global productivity, clearly an inflationary force, but it's also bringing opportunities for different regions. And you asked me about Latin America, and clearly countries like Brazil or Mexico are benefiting from this trend, both on the nearshoring terms, but also in accepting investments that otherwise wouldn't be made on that region. I'll give you an example. Last year we have big transmission lines and auctions in Brazil, and Brookfield is always a good player there, and have some transmission.
The best, not just good.
Yes, very good. Always with good advisors locally. But Chinese companies were big players in these auctions, big FDI announcement.
Yeah.
Like $5 billion was the last round in November of last year. But if you are a Chinese infrastructure company and you want to invest $5 billion abroad, you cannot do that in US. You cannot do that in Europe. You cannot do that in Australia. You cannot do that in Canada. Maybe in India. In Middle East you can do, but they don't need your money. Africa you can do, but it's more lack of institutionalization maybe. So there are not a lot of players for that. And so for these countries that are more neutral countries in this big geopolitical game, you have opportunities and you have a change in global investments, geopolitics. So for me, it's a reality, and we see it happening right now.
Bruce, we've talked already a little bit about decarbonisation, and we've talked deglobalisation. Again, feel free to chime in on any of these, but digitisation, everybody, you can't have a conversation. We've managed to go 46 minutes so far without anyone mentioning AI, but we're going to have to do that, obviously, because this is does seem to be such a transformative technology, and so rapidly transforming every aspect of our lives. And I'm wondering about, from your perspective, from an investing perspective, we talked again a little bit about the way we've seen some of these, company like NVIDIA is the obvious example that, has caught the AI wave. What are the other kind of things we should be looking out for as this becomes more embedded?
So I would just say this phone, 20 years ago, nobody had one. Today, you get everything on it. And it's because this goes from here to a fiber line, it goes out, goes up to a tower, goes across town, goes down to some data center into a cloud. And that build out is dramatic. So the opportunities on that whole spectrum are enormous. And they've been building, like we've been building data centers and towers and fiber for 10 years. It has been increasing and doubling every year for 10 years. And AI has taken it almost like this in the last 6 months. And there's two things. One, it's all the infrastructure that I just mentioned, but it's all powered by green power. These AI and cloud companies all want renewables. They need it to be green. And so the amount of build out that's happening on that is very, very significant. We just signed a deal with Microsoft to $15 billion of renewable power. We'll build them out over the next 6 years. And that's only getting started. You raised that very timely. There's a question from the floor, from the audience, to exactly that point. How do we square blockchain and AI with decarbonisation, given the immense energy requirements for these? There is just, by the way, it's just, there are some paradoxes, aren't there here? I don't want to overstate it, but paradoxes or contradictions. That is one example. Another one is, the growth, the dramatic growth. Well, it's not quite as dramatic as we thought, but what is still expected to be significant growth in electric vehicles, which is obviously creating huge demand, additional demand for electricity. I wonder, are you reasonably confident that these apparent contradictions are being resolved, whether it's by things that you just talked about, a massive Microsoft sort of renewables So I'm not going to
investment?
talk to blockchain. I think I have an expert beside me, so I won't talk to that. But what I will talk about is just the amount of energy that's getting built and the amount that's needed. And so we're electrifying over the next 25 years, we're going to electrify most industries. And the very interesting, or the most important thing is, in most countries of the world, the lowest cost bulk electricity is solar or wind today. But what we need is batteries.
Storage, yeah.
And we need less power consumed by many things. And the technology geniuses of the world who created all these things need to put their minds to their chips consuming less power. And so it's going to be some of everything. We need to build more renewables. We need to have better batteries. They need to use less power with their chips. So we need to consume less. We need to build more. But it's inevitable. The electrification, just for perspective, the last 20 years, flat electricity in the United States. To make it very simple, in the next 20 years, it's going to double. That's an enormous amount of capacity that has to get built. And look, when great minds get put to things, things happen. And the fact is, it is the lowest cost bulk electricity in most places. People just have to get at it.
Charlie, everybody's got their own list of any of these Ds in particular. You want to particularly address decarbonisation, the digitisation again. Any of your thoughts on digitisation?
Well, when you think about what digitization, AI, any of these things. I think, just to personalize it for a second, I think if you're running a business of almost any size, you have to look at it and say, this is one of the most exciting times to be running something, because it's not business as usual. If you don't think differently about what you're doing and how you're doing it, you're going to be left behind either by someone who's doing that as an incumbent or someone who's starting. So I think, the reality is, it's just what we're seeing is, it's not reversible. It needs to be controlled. Things need to be done properly, but it's going to change the nature of almost anything that's done. And when you then say, well, what are the knock-on impacts of that? I think this is where, Bruce's point is right, where you look at it as, it's not just AI. In order for AI to be what it is, you need to have the data centers, you need to have the cloud infrastructure, you need to have the electricity to drive that. In order to satisfy those electricity requirements, you need more sources than you have today. That creates a host of opportunities. And so I think when you just look at, what this all means, it's just acknowledge it's one of the most exciting times, but you need to think differently about where those opportunities are and how your own business is going to profit from them.
A couple of other specific questions from the audience before we wrap up with some closing remarks. Back to commercial real estate, and again, maybe Bruce is for you or Charlie for you. How does commercial real estate get affected by the migration of capital and companies to Florida, Texas, and other states, I guess particularly from California and the north and elsewhere? And it says, aren't these assets permanently impaired? With interest rate reduction may not be helping that much. I mean, is that kind of big demographic change? I mean, that surely is leaving, significant sort of pools of real estate, both residential and commercial, in certain areas that are...
Well, I mean, I think the answer is, yes for some and no for others. I mean, the fact that, there are buildings that need to be torn down, that need to be repurposed, which is not the easiest thing to do because of permitting and whatnot, but that is the reality of what's going to happen. And because what they were built for is not the purpose they're going to have. But there are plenty of other purposes that exist for that physical site, and so that creates opportunities. And so I think, there is this, whether it's migration of people, whether it is the types of people that wind up in some parts of the country versus others, the world's not stagnant. And unfortunately, when you build a building, it's not the easiest thing to convert from one thing to another, but that's what's going to have to happen.
Well, I think
Yeah, sorry, Jenny, go ahead.
I was just going to say, I think the governor of New York, I was talking to yesterday, was commenting on they're trying to create an incentive program. I think she passed some legislation to incent commercial real estate owners to convert office into residential, that they're underbuilt on the residential side. But even then, I think most real estate people probably say it's not quite enough yet. But I think that there's going to need to be some efforts to do that.
Bruce?
Yeah, two little observations. One, Miami and Austin are often quoted as the places where everyone wants to go. And yes, some went there and some are going there. But if you're a major corporation and you need technology or financial people, they're in New York or San Francisco. They're not in Austin or Miami. Like, there are small amounts. And if you run a small hedge fund, yeah, you can be in Miami. But if you need 10,000 people, you're in New York. And so that's not changing. It's not changing for a long period of time, meaning you will have to build, you can't do it in Miami, but you will have to build a whole city. And they just don't exist. So that's the first point. And second, look, I just say, yes, there are some forever, like Lower Manhattan was Wall Street, and Wall Street became a residential district. Yeah. All you need to do is hit land value, and then the entrepreneurs came in and made a lot of money building residential. So it's not that, but at the top end, these buildings are full and rents are very high. It's that tail. Yeah. It just always has to get converted, and somebody has to write it down to that point, or somebody has to give incentives to get there. And New York's the one place where it does happen, because land values are very high. It's an island, it's very constrained, and therefore stuff converts very quickly. Many other places it doesn't, and that's where a lot of issues are.
A final question, I'd just like you all to weigh in on this. We've obviously we've touched on this in the course of the conversation, but I want to situate all of what we've been talking about in a kind of global context. And it has been one of the most striking phenomena of the last 5 years or so, certainly post-pandemic, maybe arguably a little bit before that the US has been the sort of standout performer in many respects, and I know we can, and Andre, you may want to quibble with that, certainly in terms of some emerging markets, but if you look at the broad economic, financial performance, Europe has been pretty stagnant. China, of course, has been the big story of the last 5 years. The challenges that's faced, everybody's gone from thinking China was going to be the dominant economy in the world to thinking, well, maybe it isn't anymore. Emerging markets have had their different challenges. The United States, and again, you look forward-looking, whether it's in terms of market expectations or whether it's economic forecasts, it does look like the U.S., continues to be, perhaps, defying some of the odds, the kind of, again, the driver, the world's sort of predominant economic driver. And I just wondered again, why all of you can just weigh in just to conclude this, A, whether I'm right, or I'm missing something, and B, are you all confident that this is going to continue? And I'll start, Andre, with you.
Yes, I am, as long as you don't mess up. But it's the harvest of a combination of a lot of things in U.S. It's a free market, functional democracy, best education in the world, best university in the world, innovation, and very functional and deep capital markets.
All right, we're about,
if you put
we're
all of
about
that
2 for
together,
5 on those at the moment, aren't we? That's,
if you put all of that together, you have outperformance. Right? So I'm long-term bullish with U.S. Of course, you have different cycles, different political leaders, and you can always mess up with that. Right? If you look at China, and this amazing cycle of China was related to big infrastructure investments with tremendous productivity gain, migration of population coming from rural to urban areas, amazing labor force arbitrage in terms of costs, and all of that in a wild capitalism sponsored by the state. So it's a very specific combination, but I changed it.
Yeah.
Right? The new marginal infrastructure investment doesn't bring the same productivity. The labor cost arbitrage is not there anymore in a small fashion, and even the Chinese capitalism changed. It's not exactly the same. So the consequence of that is some loss of momentum. So that's my comparison with you.
I just say making money and good economic circumstances are not always the same. It's good to be in countries that have good rule of law and cultural respect, capital, and all those things, but markets can get overbought and oversold, and the trick to making money is being in the countries, having people there, and I call it arbitraging the opportunities. Don't go when markets are up, and invest when they're down or on the outs. And if you're in good countries, they come and go, as Andre said. They go up and down. That's Brazil more than any. But that's how you can make a lot of money in these countries.
Jenny?
Well, I think, Andre, you said it exactly right. I'd list all those things. The tremendous amount of innovation has come out of the U.S., and there's reasons for that. I think the concern is the U.S., we need to be a culture that continues to celebrate success and not beat down success, and we need to be a country that celebrates freedom of speech. And you see a lot of things going on right now on college campuses that is a concern. But somehow the U.S., no matter what happens, seems to lead on innovation. And to your point on China, places like China where the government can be very specific in guiding. Like you talk to people, they'll say BYD is better than Tesla, right? They have focused on electric vehicles, and they're doing a pretty dang good job there. Carbon investments on renewable. China has twice the investment of the U.S. So it can be very prescriptive and get outcomes. The U.S. is just continues to be, I think, the most innovative.
Charlie, last word.
Really quickly, I think the fact that we've done so well is shouldn't be a surprise when you look at all the pluses that the country has going for it. Whether it's innovation, whether it's the education, whether it's the financial system, our markets, the strength of banks, and so those have all come together, and you see the benefits of that. And I think when you look at how companies are prepared for the future. We all talk about the risks. We all use words that can get people nervous. But the fact is, if you go ask people, what are you actually doing in your business? What environment are you actually running the place for? It all pretty much presumes that the success will continue. There'll be volatility, there'll be ups and downs, and that is because we feel so good about what this country is all about.
Well, it is pretty much as though I think the US has managed to create a pretty damn good model, damn good system, and lots of people in the country are trying to find ways to destroy it. So on that note, thank you very much indeed to all of you for coming, and thanks very much to our panel.
Okay.
I can't believe she's going. I said, please.